Compounding is a process where the interest earned on an investment is reinvested along with the original investment, making the interest become part of the principal. This way, the initial invested capital keeps getting bigger and the process of earning continues. This growth occurs because the investment will generate earnings from both its initial principal and the accumulated earnings from the preceding periods. Compounding typically refers to the increasing value of an asset due to the interest earned on both principal and accumulated interest. So essentially, compounding is the process of earning interest on interest. This makes it different from simple interest, which is paid only on the principal. This is also why compound interest increases the value of an investment faster than the simple interest. There are 3 golden rules one must follow to get the maximum out of compounding, which are: start early, be disciplined, and have patience for long-term investment. All these 3 rules point to only one thing: it requires time for compounding to work. The more time you give, the bigger the corpus will become. There are many videos and online calculators showing the power of compounding, so let's skip that part here in this video. Since compounding uses the interest earned from the initial principal to earn more interest, does this process work in the stock market? Sorry to say, but there is actually no compounding in the stocks on the line of normal bank deposit. Mutual funds are however designed in a way to extract the maximum from the compounding. But how? Mutual funds exploit the idea of compounding by adopting the growth option, where the fund manager reinvests the profits earned in the underlying scheme. This helps to generate greater returns than one would expect from the fund's dividend option. Also, with a mutual fund, if you increase your investment by certain amount each successive year, compound interest will be calculated on the new investment along with the existing investment, and the returns on it gets compounded. But with stocks, compounding is trickier. Stocks use only one principle of compounding, that is time. It is the value of the stock you hold that gets compounded. Imagine you have invested Rs 10,000 in a stock. The first year the share price rises by 5% to Rs 10,500. Compounding will become apparent only from the second year. Let us assume that the share prices appreciate another 5% in the second year. This means your holdings are now worth Rs 11,025 because the Rs 500 you gained in the first year also appreciated by 5%. But do bear in mind that the reverse is true as well. You can lose exponentially if your holdings lose value. But this is not the only way how compounding works with stocks. Remember the 3 golden rules, all of which indicates to time and patience. With time comes stock splits and bonus stocks. Let's see this with an example. Let's assume that you would have bought 10 shares of Wipro in the month of July 1992. Wipro has offered following stock splits and bonus stocks since 1992. Owing to the stock splits and bonus stocks offered by Wipro, if you would have been patient enough, today your 10 shares would have grown to 16,000 shares. I could not get the share price of Wipro for the year 1992, but let's consider its price to be Rs 10 per share, keeping in mind the share split on 30th of October 1990 from face value of Rs 100 to Rs 10. Hence, in 1992, you would have spent Rs 100 to buy 10 shares of Wipro. Those shares would have compounded through stock splits and bonus shares to 16,000 shares with current value of more than Rs 62 lakh. Rs 100 to 62 lakhs in just 30 years. So this is how compounding works in the stock market. Invest the money in right stocks and wait. Time will compound your money and grow it manifold. And by the way, while number of stocks grow through splits and bonuses, the amount received through dividends also increase. 10 stocks of Wipro bought in 1992 would fetch you dividend on 6,000 stocks in 2010, 12,000 stocks in 2017, and 16,000 stocks in 2019. This is all for today's episode. Hope you would have liked it. Please subscribe to my channel for more of such videos. See you in the next one. Till then, take care.